Hey guys, welcome back to the Capital Mindset Show. Today we're going to be revisiting Stanley Black & Decker. So this is a company that I did talk about back in November, and yeah, it's been a long time. So if you guys actually take a look at that content library that should be found in the description below, you guys can find the video. And I'm so happy I made that because now I don't have to pull up the video necessarily all the time and show you guys what I said in the past. You guys can just go see it yourself if you so choose. Otherwise, I will just summarize basically what I said. In summary, the business was good, but the price was too high at the time. Okay, the price was just too high, and now the price has come down substantially. At the time of filming that video, the price was $188.09. On today, it is, and I shall actually pull this up because I think we should talk about it anyways. It is about $119.20. So I'll pull it up here. So in totality, and the video was posted around November, whatever, that's close enough. So about 36%. 0.6% down. Okay, so remember we had the liquidity crunch and all of that jazz, and but this company, why is it affected by it, you might ask? And by the way, it's because the reason why it was expensive was I needed a higher margin of safety at the time, because this company, and this kind of connecting the dots here, this company is more susceptible to the wider economic health of the economy. So Stanley Black & Decker, you might know some of their products and brands. So if we actually go to their website here, I'll show you, for example, you might be familiar. So if you go through their who we are, our business stability, you probably see DeWalt. They own DeWalt, Black & Decker brand. So you probably are familiar with some of their products across the board. And when you think about Stanley Black & Decker, I want you to think blue chip industrial, not blue chip to the level of 3M, but blue chip enough. Okay, it's a $17-18 billion market cap. It was close to 20 billion at the time, or above 20 billion at the time of the last video, which again, I'll show you the video here, but it was posted on November 3rd, 2021. And again, you can go to the content library found in the description. You press Control F or Command F, and you type the ticker SWK. You should be able to find it. By the way, all the memes are on here too. Just type in memes, and then it takes you to all the videos as well. So just right here, if you see it, it's right there, line 65. But if you type in memes, it should show up, and then you can see all the memes that have been posted on the YouTube channel. Of course, the Instagram has other memes as well. Okay, so enough of that. I just want to focus on Stanley Black & Decker. So Stanley Black & Decker, again, what we see or what we witness is a bit of a drawdown. How I can explain it to you best in simple terms is economy bad, therefore SWK performance bad. So market price in bad, okay? Now let's go over to the investor presentation and kind of see what we got. This is the sales pitch. So if we don't like anything what we see here, we're probably not gonna like anything else. So when we take a look here at global leader, right? And this is the first time I'm seeing this, so I'm just gonna be going through this with you. We see that they have 25% exposure to infrastructure and engineering fastening in the industrial space. Then they have tools and outdoor on the left-hand side, and this is the bigger segment. So here we see outdoor power equipment, hands, tool storage and accessories, and power tools. Now think to yourself, okay, what do they got going on here? Well, we can think about inventory levels, right? Home Depot, Lowe's. How are the inventory levels doing? Well, we heard from them. Inventory levels are doing meh, okay. And so Stanley Black & Decker probably doing meh, okay. And when we consider, like, what environment are we in? Well, on this channel, we've been talking a ton, absolute ton, about the liquidity crunch for, I guess, months now. I don't know how many months now that we've been talking about it. But anyways, with that being said, one of the symptoms that we've been discussing about the liquidity crunch is a crunch on consumer spending, on this discretionary side. Well, what can be more discretionary than doing these products, these at-home projects on your home, right? Buying that nicer piece of equipment so that you can do the job slightly easier instead of using simpler tools, right? Are you really going to replace that drill maybe? I don't know, you know? Or, you know, you could maybe make the argument that, you know, maybe more people want to buy more of this stuff so that they can do it yourself and save some money. Maybe that's the case. Okay, so taking a look at this other thing, they have the strategic framework. Okay, so what are their long-term financial goals? This is kind of how we can gauge management's idea. Okay, the dividend continued growth, cool thing. Okay, whatever. Financial performance, what they want is 10 to 12% EPS growth. Maybe we can model that out when we go to the valuation portion of this video. Revenue growth, 4 to 6% organic. Okay, 10 to 12% total. That 10 to 12% EPS growth probably comes in from some form of share buybacks that they lower the amount, and then that actually increases earnings per share because you delete the shares. Now taking a look at the other stuff, they do see, okay, plus 10 working capital returns. Okay, that's fine. Okay, credit rating. I hope you want to maintain a strong investment grade so you can lower that cost of capital. But all right, so margin expansion. They're using all the buzzwords here. I think they have good brands as far as in the category. By the way, they got some of those brands from the destruction of Sears, I believe. So now let's see here. Stanley. Okay, Stanley Black & Decker creation model. Okay, so this is their business model, right? They have world-class brands, attractive growth platform, blah, 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 and then they go strong innovation business. Okay, then it goes down, powered by the operating model. Okay, I see what they're trying to say. Now, I don't know if this is really important for us to really evaluate them, but cool. Okay, this is the pat on the back slides, so we're going to skip over these, skip over the pat on the back slides. But I hope, okay, so I hope that you're not, just throwing trash everywhere and, treating people badly. I hope you're not doing that. But, pat yourself on the back. I don't really mind too much, It's, okay, still patting on your back. Geez, man, patting on your back. I call that pat yourself on the back slides when the company's just like, look how amazing I am. Look how wonderful I am. When you dedicate so much to it, it makes me a little bit concerned personally. I saw that some of you in the Discord feel the same way. But for me personally, it just makes me, I don't know. I get a little bit uneasy when you're trying to just pamper me, the investor or the potential investor, saying how good you are. Okay, so, oh, we're still there. Okay, like we're still, oh my God. Okay, are we still in this? I think we're still in this. Yeah, we're still in this. Is in Power Makers, what is this? I think we're still in this. Yeah, we're still in this. Okay, talent. Cool, finally, something. Or are we still in this? Oh no, okay, I guess. No. It's still patting on the back with diversity and inclusion buzzwords there. All right, so okay. So I think the rest is patting yourself on the back. Not too good there. My gosh, how much patting on your back? Oh my gosh, what the ESG all the way. This is what they're going for. Yeah, you see, like this is just patting yourself on the back kind of stuff. Okay, cool. Oh wow, I'm just making fun of them at this point. This is so amazing. You guys are so cool. All right, finally. All right, cool. Here we are. All right, so how many slides was that? That was a lot of slides. Oh, I guess they stopped here. Okay, so this is now an important slide. So delivering value to our shareholders. Well, I mean, is that really your priority, or is the other stuff the priority? But anyway. President CEO salary bonus. Okay, so I like to see that they are paid more with long-term equity, okay, instead of salary and bonus. So you try to get the managers to feel like owners. So I like that. And then that's what they're kind of highlighting to you here. So that pay structure is important. Diluted EPS, they are growing the EPS drastically, okay, but I don't know how much of that is demand pulled forward because of the pandemic. So, we've talked about a lot of those companies. Okay, so here we have some sort of, yeah, we don't really care about that. So with that being said, what we take away from this is their long-term projections are 10 to 12%. And yeah, lots of patting yourself on the back there, but I think that's more funny than anything. We have to have some humor on these videos here and there. And there you go. There's your humor for the day. Stanley Black & Decker is definitely looking out for you, and they're going to save the world. So onto the model, let's actually plug this in. And this is from the Costco video. So if you haven't seen that Costco video, feel free to. And let me move you guys over here. Okay, so SWK. Now, the thing with SWK is what we're going to have to do is take into consideration that it looks extremely cheap once it ports in. I think it's actually already ported in. So it looks extremely cheap on a short-term basis, or sorry, expensive on a short-term basis. So we're going to have to make that adjustment. So we're going to say yes and yes. So in that case, what we've basically done is we've normalized the cash flows. And I want to state, ignore this because we're not really there yet, but we've normalized the cash flows, and I basically asked the model to do so for me on my behalf. So I just indicated yes and yes, and there we go. And by the way, you notice I did rename it. I've been always talking about how lazy I was because I originally was created to do so with financial institutions, and then I just called it that. But then I retrofitted it to work in financial institutions and other kinds of companies. So here we are. So now I'm looking at it from the perspective of a normalized cash flow basis because, as you can see here, the price to free cash flow looks extremely high, and instead I took a normalization variance of that. Now, of course, what basically that is saying, you see this massive dip, okay? It's a temporary dip that's occurring in the cash flows, and the analyst estimates are that it will recover. So basically, again, I'm normalizing it. They are well below trend line in 2021. I think they're going to come right back up. Now, shares outstanding can fluctuate a little bit. It has basically been dilutive slightly by negative 0.77. If you wanted to assume that, sure, why not? But what I want to say is right now at these prices, it is a better bet than it was before. I will say that I would like the price to come down a little bit more for me, for that extra margin of safety. If I don't need that much of a margin of safety, then I can make the case that right now is an accumulation point. Okay, and that's, again, if we're going off of that 10 to 12% long-term growth. I took a look at what other analysts were saying. I found that the majority of analysts are saying the same thing, about 10 to 12%. I saw some pessimistic measures in the 8 to 5%, but the majority were in that 10 to 12% as well. So if that's the case, then, you know, we're in the accumulation point, and it is a lot cheaper than the previous video. So this is considered to be an update on the stock. Remember, I don't own the stock. I have no really plans of owning the stock, but I feel like I can still provide what is hopefully a productive and insightful and valuable opinion and insight. So if you found value in this video, feel free to leave a like, comment down below if you have any questions, and also feel free to check out the other content. Now that the content library is there, you guys can check out pretty much a lot of things. I want to make a disclosure. Please remember this, and I should have made the disclosure at the beginning. I'll start making the disclosure more often, that the content library, remember the dates. The dates are very important, especially in the financial industry. Things can change on the dime. Sometimes things change to the worse or to the better. So if I try my best to always use careful language because of that, because of the understanding that things can change and things are dynamic. If I said something 6 months ago about one stock, I might have said, these are the risks, and if they play out, they're bad, and if they don't play out, not bad. But maybe I sounded really pessimistic. But remember, if those risks don't play out, market might reward that, okay? So just keep that in mind. And the whole idea is to provide perspective and hopefully value in some feasible way. All right, on that note, guys, thank you guys so much for watching, and this is your update on Stanley Black & Decker. It will be updated on the sheet as soon as this video is published. On that note, guys, have a good one. Bye.